In this week's update, what latest inflation data means for markets, geopolitical risk soars, and US earnings season underway. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, look, not a lot has changed. There's been lots of ups and downs in the last week, but really the outlook has not changed. The US inflation data came in still too hot, and the market has had a couple of negative intraday reactions to that, but nothing that's really sticking. Basically, this is, I've been saying for some time, this is a market that just seems to want to go up. Now, the inflation data was in line in many or most categories, but there are still some categories that are still accelerating, and concerningly, fuel cost, electricity cost, and accommodation cost, be it either ownership or rental, are still above expectations. And of course, they're the critical ones for the consumer. So that's the situation in the US. Now, when we look at the money flows, as we'll get to in a minute, they're really not saying anything different to what they've been saying pretty much all year. So certainly there is absolutely no evidence of any sort of topping formation that would lead to a bear market. Otherwise, the growth focused sectors of the market would be doing something quite different. So yields are volatile. They've been kicked around quite a bit in the last week, but net, they went lower. So that in itself tells you something. So US sector flows, they're still supporting growth. They're not supporting the defensives. So, to my way of thinking, this is a market that the orientation is to the upside. So the net result of all these cross currents, and we've got many, and now we've got obviously geopolitical risk in the Middle East to add to Ukraine and the China-US tensions, and concerns about global growth and inflation. The list goes on and on and on. But the net result of all of that is that the most advantaged businesses are just going to keep marching on, like they always have. Every now and again, they have a period of weakness, perhaps where the PE multiples have got ahead of themselves and there's a bit of an adjustment backwards. But basically, the advantaged businesses just keep going. And what do I mean by that? Well, it's where the business model has a significant strategic advantage. They've got an economic moat that protects them, insulates them from their competition. They may have the best in the business management. They've certainly certainly got pricing power. So all these things, if you can find businesses and narrow your focus to businesses that are in that position, then just don't let what the broader market is doing worry you too much. It's a fairly straightforward process. And then, of course, you want to buy them when they've got an edge, because advantage businesses spend most of their time probably being fully valued to somewhat overvalued. But from time to time, for whatever reason, that it's generally it's temporary or it's a misunderstanding, from time to time, the prices sell off and they provide wonderful entry opportunities. But you know what? You never really get an opportunity to get onto those unless they're already on your watch list, unless you're already targeting those stocks and you've got a bit of an idea of what would be an attractive entry price. If you haven't done that work in advance, it's very difficult to, during a period of general market weakness, to suddenly scurry around and try to uncover what are the gems. The work's got to be done in advance. And that's what I spend a hell of a lot of my time doing. And then, of course, the final thing is sometimes the price just doesn't respond. The market doesn't reward a really, really good situation, a really good growth situation for some time. So you've just got to allow the time for the market to reward those businesses. So it's not a difficult formula, but it's not that easy to do. And the reason it's not that easy to do is because what's swirling around in our heads. And if you can get clarity and process that helps you deal with what's swirling around in your head, then you can do infinitely better in the stock market. Okay, American stocks, the S&P added another 0.5% across the week, despite the volatility. And the overall money flows, as you'll see, are not being disturbed by the inflation data. at all. Earnings season kicked off in the US with three of the major banks, and it was positive. Earnings beat expectations, and that's what normally happens. That's the way the dance gets conducted in America. Low expectations, you beat them, the market cheers, and everybody's happy. So that seemed to have started off in pretty much the same fashion as normal. The US dollar index edged up a little bit more, 106 and 2/3, but the yield traded down. So it hit a high, I think, of around 4.85, but ended up trading down to 4.63. The VIX was higher to 19.3, and the 10-year, 2-year spread is still sort of bobbing around this negative 0.3 to negative 0.4 mark. So let's go and have a look at some charts. But just before we do that, let's just look at the 10-year yield. We'll put this on first let's look at the year to date, so you get a bigger picture sense. So clearly the 10-year yield is heading up, and the market is anxiously waiting for that to stop rising, because if this does keep rising, then that will be an increasing problem for markets. But at the moment, it's just been going really sideways for the last couple of weeks. Let's zero in on the last week and see what that looked like. Very volatile. We were up above 4.8 at one stage. We were down at 4.54 at one stage, and we finished probably a little bit in the lower part of that range. So a very volatile week for the yield, and that of course causes some confusion in the equities markets. Now, this is the S&P. But I'm going to start with it on a weekly chart. So this is the low that we saw in October of last year. So for the last 12 months, the S&P has gone from around 3550, peaked out around 4600, and is currently at 4327. So there's definitely a strong trend there. But you'll notice we've had 1, 2, and now 3 reasonably decent pullbacks in the market. And you'll notice this particular one here is played out as an ABC pattern. So the way that a normal trend unfolds, when you come off being oversold, you've got a significant move up, then you've got a partial retracement back, but it tends to be just one leg down. And then you get another advance and another leg down. So all you're doing is you're retracing the previous move. But then generally after you get a very significant run to the upside, as we had here between March and July, it's then often that you will get the retracement of the whole move. So from this low to this low, at some point, that's always going to occur. And that generally plays out as some sort of ABC pattern. So there's the A leg, there's the B, the bounce, and we've had the C leg. And for all sorts of reasons that I've been covering over the last few weeks, the odds favour, particularly the money flows support this, but the odds favour that this is the low last week. And we'll have to wait and see. But we had a retracement to these prior highs. We also had, if you put a Fibonacci scale on that, we also had a retracement almost to the 38.2 as well, which is a pretty normal sort of retracement level when you've got a strongish uptrend. At the moment, you've got to look at that, despite whatever thoughts you might have, and say that that is a reasonably strong uptrend. If you look at all the weekly moving averages, they're all lined up in the right order, and the price remains above all but the short-term ones. Let's just go and look at the daily. The shorter-term moving averages have turned over as a consequence of this correction that we've had since the end of July. But certainly a good move over the last 6 or 7 sessions. Let's look at what's going on under the hood. So NASDAQ versus S&P, we're not showing any signs of, like we saw over here, where growth rolled over. It's holding up very well. Did retract just a little bit at the end of the week. still looking very solid. Semiconductors, importantly, very much the same. There's been no interruption to the pattern there. If we look at the relative sector money flows over the last quarter, energy, which did get a sharp sell-off when the price of oil fell, but oil rebounded last week and took the energy sector very strongly to the upside. Communication services comes next, down last week. Healthcare, a little bit of a recovery, and so on. We go down the line, but it's a real mixture. There's no particular standout there. But one of the things that I think is a good insight is that XLP, which is consumer staples, remains at the bottom and it's trending down. So, that's a sign that the market is not too fearful. In the Australian market over the last quarter, finance and energy are leading the way over the last quarter. And then we've got healthcare pretty much at the bottom. The healthcare majors were under pressure anyway on a bit of a valuation basis. But of course, there's been a lot of media attention of late about the impact of these obesity drugs and what impact they might have. And CSL and ResMed have copped the backwash of that. So that's the situation with respect to the US market and the money flows. Currency, we had a bit of a pullback, but we're still in uptrend, still holding above the 20-day moving average. And of course, the Aussie dollar is doing pretty much the opposite. Okay, speaking of Aussie stocks, our market gained 1.4% across the week. Might have a bit of a wobble or a bit of weakness on Monday morning, but it basically reversed the previous week's decline. However, the ASX 200 is still trading comfortably below the 200-day moving average. So that's quite different to the US market. And if you look at it on a sector-by-sector basis, information technology is the only sector that's above the 200-day moving average, which is also rising. So that tells you a fair bit about our market. Only one sector above a rising 200-day moving average. So things pretty somber in our market. Let's just take a quick look at that. So there's the ASX 200, 200-day moving average, flat, turning over. Shorter-term moving averages have also rolled over and the price is below all of them. None of that is particularly exciting. And the only one that looks halfway decent is XIJ, 200 days pointing up now and the price is above it. Yes, we've got some short-term weakness in the shorter-term moving averages, but we're now starting to reclaim the ground, and the 8-day moving average has turned up, the 20 looking like it will as well. So that's the situation with our market. Turning to precious metals, gold had a huge spike during the week, up $100 to 1933 for obvious reasons, because of the geopolitical risks that are unfolding, and who knows where that may go. And then when you translate that into the Australian dollar, which also fell, it was a massive surge in the gold price in Australian dollars. So we're up to basically $3,100. Precious metals, bit of a positive response, pretty much in line with what you'd expect with the gold price spiking, but there's no leadership. There's no outperformance. So I have nothing different to say to what I've been saying for probably 2 years. I just don't get excited by gold producers. It's got to be the de-risking process of world-class gold developers to get me interested, I'm afraid. So let's take a quick look at that one. So there is gold on a weekly chart. You can see it was a big week, or reclaimed the 2, in fact 3, 4, almost reclaimed the previous 5 weeks of declines. So a very significant week for gold, but stocks not really responding. And this is what it looked like on an intraday basis. Huge amount of volatility on Monday coming off the previous weekend's turmoil. Had a day or two of indecision, but then Friday was really a very strong period. Okay, that's precious metals. Turning to other commodities, copper 359, nickel at 833. So still struggling a bit, and these are prices that are not going to incentivize the sort of exploration needed to meet the demand that's coming down the pipeline, certainly in a couple of years' time. Crude oil back up to the high 80s again. And I think we've got the attempted takeover, has yet to be approved by ExxonMobil, of Pioneer Natural Resources, which is a huge takeover. And it really now puts mergers and acquisitions firmly back on the agenda in the energy sector, as it is in lithium, and perhaps we're even starting to see some in the copper area as well. Let's just take a quick look at what crude oil looked like. Again, let's just get the bigger picture. Year to date, long period going sideways, and then we've started to trend of late, and oil's poked its head above $90 at one stage. If we just look at the last week, you can see a fairly steep recovery at the end after some weakness in the middle of the week. There's the spot copper chart. I have no idea what this is about. I suspect it's probably just some sort of aberration in the data. This is off Kitco. So yeah, I have no explanation for that. Because we didn't see it in nickel either. So wrapping it up, your focus in these sort of markets really should be in great long-term businesses. Okay, you can have your speculative plays on the side, but that should form a pretty minor part of your portfolio. You want to be investing in businesses that are going to do really strongly with a high degree of probability over the long term. So that should be, in my opinion, the staple of your portfolios. And that can be mining, it can be non-mining, as long as they've got the tailwinds of megatrends. But you also need to retain awareness for contrarian situations, because the market regularly gets it wrong on a temporary basis. It either overreacts to some situation, and I suggest that what's going on with this reaction to the obesity drug craze is a significant overreaction for stocks like CSL and Resby. So the market quite often will do that. It'll react in an unrealistic way, and that can create some terrific contrarian opportunities. Portfolio analyst last week, we covered my favoured US stocks, of which there are quite a few, obviously, and why a great technology is never enough. Something we've been doing in portfolio analyst since it started in 2017 is analysing stocks, new technology stocks, across whatever sector it might be. It could be industrial, it could be technology, healthcare, it could be mining, whatever it might be. They've got a great technology. It looks an absolute no-brainer, and would just have to be an outrageous success and change the world. And, you look 2 or 3 or 5 years later, and the share price has lost 90% of its value. There was some initial hype, but then the commercialization reality becomes apparent. Just the vast majority of these great technology stocks, they don't ever make it. The price doesn't ever make it. So that was, I think, good insight into the potential dangers of getting drawn into, that story, that seemingly unbelievably good story. It's easy to do, but it can cost you very dearly. So that's it for this edition. There's email address and website where there's more information, and I'll be back with you next Sunday. Cheers.